You and your spouse have $500,000 in one bank account. Your paychecks go there, your savings are there, you've been building that money together for years, then one of you dies. So what happens to the $500,000? Easy. The other person gets it, right? Not always, because a few words buried in your bank paperwork can decide what happens next. Get them right, and the money may pass directly to the surviving owner. Get them wrong, and part of that money could take a very different path. And even if you get the entire $500,000, you're still not done, because 6 months later, the way your money is protected by the FDIC can change. Same money, same bank, completely different outcome. So let's take your $500,000 and see exactly what happens to it. You open your bank paperwork. Somewhere next to both of your names, you're looking for 3 words, right of survivorship. Sounds complicated. It isn't. It basically means this: 2 people own the account, 1 person dies, the other person becomes the owner of the money. So let's give you the good version. Your account has right of survivorship. There's $500,000 inside. 1 owner dies. What happens? The surviving owner doesn't have to split that account with the family. That money doesn't normally have to wait for a judge to decide where it goes, and it doesn't normally go through probate, the court process used to handle someone's property after they die. The bank just needs proof of what happened, usually a certified death certificate, before it updates the account. So $500,000 still there, still accessible to the surviving owner, problem solved, right? Only if those 3 words or equivalent survivorship terms are actually part of your account. Because now let's remove them. Same couple, same bank, same $500,000, but this time the rules can change. Now let's make one small change. Same bank, same couple, same $500,000, but this time the account doesn't give the surviving owner the right to automatically take everything. 1 owner dies, and now the money can split into 2 paths. Your share stays yours, but your spouse's share may become part of their estate. What's an estate? Simple. Think of it as a box. After someone dies, certain money, property, and debts go into that box. And before everything inside can be handed out, the box may have to go through a legal process called probate. Now, you have a problem, because you can have a will that says everything goes to my spouse and still have paperwork to deal with before certain assets actually reach you. So you wait, forms, documents, possibly a court, possibly an executor, all while part of the money you thought was simply ours is now being handled as part of an estate. But let's make this easy for you. Let's go back. Give your account survivorship rights. 1 owner dies. The surviving owner gets the account, $500,000, no split, no probate for that account. You won, or at least you think you did, because you just became the only owner of a very large bank account, and that creates a completely different problem. Okay. Let's give you the best case scenario. Your joint account has survivorship rights. 1 owner dies. The bank updates the account. And now all $500,000 belongs to 1 owner, you. Great. Except there's another number you need to know. $250,000. That's the standard FDIC insurance limit for 1 depositor at 1 insured bank in 1 ownership category. Before, there were 2 owners on your joint account. Now there's only 1. So did $250,000 of your money just become uninsured overnight? No, the FDIC gives you time. For up to 6 months after an account owner dies, the FDIC generally keeps calculating deposit insurance as if that person were still alive. Think of it as a countdown, 6 months. Your old coverage doesn't disappear immediately, but the clock is running. And when those 6 months are over, the FDIC can recalculate your coverage based on who's actually left on the account. So let's say nothing changes. Same bank, same account, same $500,000. But now there's only 1 owner. Your insurance situation may no longer look the same. And if that bank fails after the grace period, the difference suddenly matters a lot. So you survived the first problem, you kept the account. Now you have 6 months to understand the second one. The clock starts the day one owner dies, 6 months. Month 1, your $500,000 is still there. Month 3, still there. Month 5, nothing looks different. Then month 6 ends. Now the FDIC can look at who's actually left on the account. Before, 2 owners, now 1 you, and the standard FDIC insurance limit for one depositor at one insured bank in one ownership category is $250,000. Your balance, $500,000. So did the other $250,000 disappear? No. If the bank is fine, you may notice nothing. But if it fails after the grace period, that difference matters. You kept the money. But eventually there's one more question: who gets it when you're gone? Now you're the only owner. The $500,000 is yours. But what happens when you're gone? One option is a POD beneficiary. POD means payable on death. Say you name your daughter. While you're alive, you control everything. When you die, the bank already knows who's next, and the account can generally pass to her without probate after the required documents are provided. Simple. But now 10 years pass, you have another child. Your will says split everything equally, $250,000 each, but you never updated the bank account. It still names only your daughter. Your will says 2 children, your bank account says 1. And for this account, the beneficiary designation can control where the money goes. That's the mistake. Your life changed, your paperwork didn't. So let's check yours. Back to today, your $500,000 is still in the bank, and right now you still have choices. You don't need to memorize every rule. Just check 4 things. Number 1, ownership. Who actually owns the account? Number 2, survivorship. If one owner dies, does the other automatically keep it? Don't assume. Check. Number 3, beneficiary. Who's listed today? Your spouse, your child, someone you added 15 years ago. Look at the actual name. Number 4, FDIC coverage. How much is actually insured under your current setup? Because $500,000 in the bank doesn't automatically mean $500,000 insured. Then compare your beneficiary with your will. Do they tell the same story? Maybe everything matches. Great. Or maybe you find one old name, one missing survivorship provision, or money above the insurance limit you assume was covered. That's why you check now, while you can still begin it. Your $500,000 never changed. What changed was everything around it: the owners, the insurance, the beneficiary, the paperwork. 3 words could decide what happens when one owner dies. 6 months could change how the money is insured. One old name could decide who gets it next. Same $500,000, completely different outcomes. So don't discover the problem when your family is standing at the bank. Check the account, check the beneficiary, check the insurance, and fix what doesn't match, because the best time to discover a problem with your money is today.